Greetings, everyone. I'm excited to welcome Jim Williams, Managing Director at GLC Advisors, for another special edition, Jim, our third special edition. So, really looking forward to this. So, Jim, let's kick this off. Tell us a little bit about yourself and GLC.
Yeah. Hi, everyone. Jim Williams again, Managing Director from GLC Advisors. We are a 65 person sort of national boutique investment banking firm. We've got offices in New York, Denver, LA, and San Francisco. I help lead our technology investment banking team with two other members of the firm. And just to give you the lens that we look through, we are dedicated to the mid market and we are primarily focused on founder, owner, operator advisory, and probably 90% of what we do is sell side. So these conversations with Ben are awesome. It's right kind of down the middle of the fairway. So we like to add some perspective that is hopefully value additive here as we reflect on 24 and hopefully look into 25.
Yeah, Jim, appreciate that intro. And I know in the past we've tried to, just state of the market, maybe a little
Yep.
prediction of what's coming ahead. And we've had
Yep.
two of these. So it's always interesting to see where we find ourselves. And I think it's part we're recording this early. So it's January 2025. So, yeah, Jim, let's kick this off. So, what is the current state of software M&A right now? The trends, deal volume. So give us a
Yeah.
little overview of what's happening right now.
Yeah. Maybe we can start with deal volume then. So, the last 3 years, it's been an interesting ride just to lend some context. I mean, 2022 was really a tale of two halves, right? We had a good first half. Things really started to slow down in the second half. 23 was just a down, slow year. Businesses struggling. M&A market wasn't great in terms of the number of deals getting done. But valuations had come way off from where they were in 20 and 21, and really even the first half of 22. And 2024, was a nice but kind of slow bit of improvement in the software M&A market. So if you think about, what does that mean? So the first half of 23, we saw, call it 480 software deals get done. This is like US based software majority M&A transactions. First half of 24, that was over 550. So like a 15% increase. So that was nice. And then in the second half, it was more like a 19% increase, almost 20% increase. So you put that all together, and we had a little bit of a bounce back in 24, kind of like a 17, 18% increase in deal volume, which is really nice momentum going into 2025. And we'll talk a little bit about what we're expecting this year, but I would call 24 an encouraging year for software M&A in the US, which hopefully is a nice predictor of good things to come. So,
And I know I think we recorded this last about 13, 14 months ago.
yeah.
So late 2023, thinking about 2024. And I think we said, well, 2024, hopeful like recovery, but it sounds like maybe it wasn't as, maybe, I don't know, as high or great as we thought, but those are nice increases. So 15 to 20%
Yeah.
deal volume increases over 2023.
Yeah. Yeah. I would characterize 24, and this has been a little bit of a trend, um, not quite as good as we'd hoped, and maybe a little bit delayed. I think most people thought we'd see the bounce back a little bit earlier and maybe a little bit more pronounced. But I think some of that sentiment actually is dribbling into 25 as well. But we'll save that maybe for the back end of this conversation. The other thing that we obviously track is valuation, and so we track call it 1,000 deals a year, Ben. Again, US sort of software deals. Not every one of those deals has a reported deal value or a multiple, but several hundred do. So that's the data that we look at all the time. And across deals with reported value, we continue to kind of hover in that 4 to 5 times revenue range. And keep in mind, that's across big deals and a lot of small deals, but that's largely in line with where multiples have been for a long time. If you remove 21 and, kind of the last few years of the dip, we're getting back to more normalized numbers in terms of typical multiples. I mean, that's where multiples were in 18 and 19. Obviously there are deals that get done for low multiples and deals that are double digit multiples, right? Those things all happen throughout a year, but I think we've normalized around something that is much more in line with where things have historically been. It's definitely off the peak of 21, which was, we were seeing things kind of on the median at like 6, 7, 8 times. So just, highly anomalous at that point.
So, all right. So, and this is, we're talking private tech companies, right? With the 4 to 5
These are
X.
M&A. Yeah, these are M&A deals that are reported. So this isn't sort of public equity multiples.
Okay. And 4 to 5X revenue multiple range, are we talking recurring revenue then?
Total revenue.
Total? Okay.
Right?
So total
Yeah.
revenue
Yeah.
multiple. Okay.
Yep. Total revenue. And, the vast majority of that revenue in these software deals, Ben, is now subscription revenue. There are just not that many license maintenance deals out there anymore. And pro services is generally pretty light. So we use it as a proxy, for recurring revenue, certainly as we look at the deals at a macro level.
In talking about revenue and recurring revenue, and
Yep.
it's, I wouldn't say like, we're talking about this all the time, not like a new topic, but like, what is recurring revenue now? What is ARR and the definition of ARR? And in the past, right? SaaS 1.0, subscription revenue, fixed monthly, annual contracts. Now we've got variable revenue streams, usage, processing, consumption, transaction, etc. You think about the other, right? Professional services, managed services, maybe there's a hardware play.
Yep.
Now, is that conversation coming up when you work with founders and then you work with acquirers of, well, what is the characteristic of the top of their SaaS P&L and those revenue streams? Is that
Yeah.
coming up of like, well, what truly is this revenue that you're presenting on your P&L?
And only in every deal then. Yeah, no, look, this is, and you do such a great job of coaching people through this to really begin to get your head around how someone who's peering into your business is really going to think about your revenue streams. So in every single deal that we do, there is scrutiny around rev rec, but also just the underlying nature of, to your point, but well, is what is recurring revenue, right? Does it have to be an annual contract, right? There are many buyers who look at it and say, look, if it's month to month and it's not an annual contract, I'm going to use this lens on those numbers. If it is transactional, I'm going to use this lens on those numbers. And a lot of it has to do with all the stuff that you coach around too, around retention, right? So the quality of those revenue streams, the nature of those revenue streams, the nature of the underlying contract behind those revenue streams is all something that gets a lot of pressure from investors and buyers in one of our processes. So that's something that, early on, we spend an inordinate amount of time, not only working through all the things that you would think we would work through at bulletproof numbers, but also be able to communicate the business model and the revenue stream model to buyers in a way that is clear and concise, and not muddy, because a lot of the times when we see kind of multiple types of recurring revenue streams, these things they're all piled together into one number. And it's part of our job to help founders and owners pull that apart with their finance team so that, we're not on our heels in the middle of a process trying to explain that what was presented was not exactly as it was presented, meaning, there are elements of the revenue streams that maybe are different than people would have expected if you didn't get in front of it and parse that apart. So yeah, it's a huge piece of every single deal that we engage on, for sure.
And with, yeah, so important. I have so many conversations with SaaS founders about this. And when you think about, okay, subscription, pretty clear, hopefully.
Yep.
And then those variable revenue streams. So let's say we have a usage model and,
Yep.
it seems like no longer do I see, like early stage SaaS, maybe we just start a subscription or maybe just
Yep.
purely usage, but then sometimes see subscription plus usage. So
Yeah.
let's say subscription and usage are material revenue streams on their P&L. And, when I work with SaaS founders, we try to, all right, we create separate MRR schedules, we create separate retention schedules.
Yep.
What do those stories say separately? And
Yep.
if they say a better story combined, let's do that as well. What are you seeing? Like, if we have quality, sticky, variable revenue, are we going to get that same revenue quality number as subscription?
So generally speaking, it's going to be yes or close to yes if all the retention dynamics around it are similar, Ben, and the model is one in which you can credibly say it is a recurring revenue stream, meaning that whatever is in the background of that recurring revenue, that sort of transactional or usage-based model, is something that's going to be renewed and continuous and go forward, right? If you've got excellent retention around that on all, you got to look at it through logo and you got to look at it through gross and net, which can get a little odd when you've got the ups and downs in a usage-based model, right? But there are ways to kind of think through and normalize some of that, which I'm sure you do with your clients, so that you can tell a concise story around that. We've had good success getting credit where credit is due around revenue that is recurring in nature that might not fit kind of the classic, okay, I've got an annual contract, it's paid up front, then I defer it, then I divide it by 12 and I spread it out over the year, right? Kind of the cookie cutter piece of recurring revenue. But what I will say is you've got to get your story straight around it, and you've got to have data in the background that substantiates that it is indeed recurring in nature, or someone's going to look at it and say, I'm just not comfortable giving you the same multiple on that. And by the way, there will be people who say that regardless of how good the numbers are, if it's usage-based or transactional, even on payments revenue, right? So it's a little bit eye of the beholder, frankly, but if you lean into it the right way and can explain it and back it up, we've had a good track record of getting credit there.
Yeah, no, that's good to hear. Yeah, interesting to hear your perspective. And because you need good data, MRO schedules, RevRec, all that good stuff. And one last thing here before we move on to a next question, but you mentioned business model earlier.
Yeah.
And I have these conversations all the time, again, with SaaS founders of what, because sometimes it's not as simple as, yeah, I offer a $50 subscription or a
Yeah.
100,000 ACV subscription. I've got some professional services. I've got some managed services. Now, is this a tech enabled play or is this a standalone product?
Yeah.
And really trying to decipher like what is their revenue business model? What's their pricing model? Like, what are you offering here? Is it IP powered revenue? Or is it people powered revenue in combination? Because I know it seems like that can scare people away as revenue goes up and
Yeah.
we need to hire
Yeah.
to
Yeah.
support that
Yeah.
delivery of revenue. So
Yeah.
how important is it, because like you and I work with tons of SaaS companies and sometimes it takes me, it takes like a 30-minute conversation, even 60 minutes just to figure out like what is their business in that model. So how important is that for that founder to really nail down like what exactly are they offering?
Yeah. I mean, it's fundamental to a successful transaction. I mean, you've got to be able to tell your story in a way that communicates the value of your business, but is also very clear in what you are and or not doing and how you're doing. And, where we see this probably come up the most often, Ben, and you probably see this too, is, your revenue model begins to show itself in gross margin. And that is where we get a lot of pressure in a process, while we spend a bunch of time up front making sure gross margin and all of your cost of revenue is properly loaded, because someone will get to the bottom end in a deal. It's just going to happen. So if you don't have support costs in there, or you're pushing people costs down below, if you're a tech enabled services business, right, which is going to have fundamentally a different gross margin profile, if that comes to light during due diligence, now all of a sudden you're answering uncomfortable questions, right? So getting that story straight around how are you delivering, your product or your service or some combination thereof, it's kind of 101 in terms of get yourself ready to go to market. And it absolutely impacts, people's thoughts on value. The people, if your business is heavier on the people side, right, there are implications, at least in the mind of investors and buyers, around scalability and things of that nature. It's just a different looking equation. If the people element is heavier, then, you got a 86% gross margin, lightweight SaaS business, right? That's a different story. You got some support in there, but, some tech-enabled services businesses can be much heavier on the human capital side.
Yeah, and you hit some huge keywords there because that one of my top coaching calls with SaaS founders and their accounting teams or bookkeepers is gross profit, COGS versus OPEX, the correct department structures, correct coding. And, just had a call this week with a founder and looking through their P&L and, subscription revenue had a lot of services revenue, and then the next step is, well, all right, what are the margins? What are those producing? Because you absolutely have to know that before you go to market. And I always tell founders, like, you don't want the acquirer telling you your financial profile. Like, you've got to have that locked
Yeah.
in and you tell that
Yeah.
story to
Yeah.
them versus them telling it to you, and know your numbers before you go.
And that's exactly right. And look, when you've got, even if your revenue streams are indeed recurring and one is software and one is services, or there's a blend, being able to apply, costs to those revenue streams independently is a huge deal, right? Being able to pull that apart and show someone, here's this revenue stream, here are the costs, here's this revenue stream, here are the costs. You put those things together, and there's the financial profile at the top line and really at the gross profit level of this business. Hugely helpful, right? And getting in front of it, you're right. You never want someone in a process telling you your numbers. If that's happening, you're on your back foot, right? Which is a bad place to be when you're trying to maximize value and put pressure on buyers and investors and get something done quickly. That's the spot you don't want to be in.
Yeah, and really you can't cheat here, because I always say, like, if say you've over, estimated, or your gross profit is inflated and it shouldn't be that high, but then your OpEx profile is too burdened. Like, you're gonna get caught somewhere. The question is gonna come up. So we might as well have just the everything coded correctly and understand what's working. But, Jim, we could talk, I mean, we could talk hours for just on gross profit and margins and all that
Yeah.
stuff, and going after, that pure play best in class 80% gross profit. But let's talk, 2021, obviously, crazy valuations, high valuations, things
Yeah.
have come down since then. And I know when we talked in the past, like, there was still maybe some struggle in that gap between buyer and seller expectations, where we
Yeah.
had such great multiples and now we still want those multiples, harder to get deals done. Now, where do we stand now with that bid ask spread and the buyer seller expectation when going to market?
Yeah. I mean, the bid ask spread, Ben, look, it's still there, but I would characterize it now as like a healthy tension between buyers and sellers, whereas before it was a chasm, and it was proving, I mean, candidly, it was just problematic in terms of people weren't finding ways to get good deals done, right? The sellers had their expectations, the buyers had their expectations, and there was no way to build a bridge between those two mindsets. And, time has a way of equalizing those things, right? We got away from 21, which was helpful, I think, for everyone. I think the reality was that 2022 and 2023, and for some businesses, part of 2024 was, maybe a level setting back to more realistic expectations around the performance of the business. Those were some bumpy years for a lot of software businesses and very bumpy years for some services businesses on the tech side, which I think has helped maybe level set around valuation for people a little bit better. And, that means that things are getting done, which is good. And people are seeing eye to eye. And I think there's more willingness on the buyer's side to lean in a little bit more, which is great. And that is aligning a little bit better with sellers on what they think is fair. And, that I think is healthy. And hopefully we'll see that, you know, persist and hopefully pick up in 2025.
Okay, yeah, interesting. Yeah. Yeah, and like you said, time helps with this. And I think, you like to borrow a line that you said in the past, where, even if the market seems a little bit uncertain, if you still have a good SaaS business, a good financial profile, you can get funded or you can get acquired. So don't be afraid. Like, but if you're running a great business,
Yeah.
deals still can happen.
Absolutely. I mean, good businesses have and always will get good multiples. Those deals are out there. And look, the last few years, there's just scarcity value for the really good businesses. And this gets back to a little bit of, businesses, some of them were struggling, but I think, and this is something, we're going on a couple of years now up here in this, so we speak to, multiple sponsors every single week, private equity firms, and we're we're catching up with folks in general, but we're also trying to get a read on the market. And, just around this sort of comment around if you have a good business, Ben, you know, for a couple of years, the feedback has been, hey, Jim, the number of teasers coming across my inbox and Sims, that's fine. It's a little bit down, but it's like totally adequate volume. What I'm struggling with is they're just not great businesses, or there's just something that's not aligning with my investment thesis in terms of it's not jumping the bar in terms of I want to put an IOI in or submit an LOI. So you've had a little bit of a quality issue in the market. And what that means is when the really good businesses, the A plus plus businesses or even the A minus businesses are out in market, they're very shiny pennies, and people are really going after them hard, which is great from a seller perspective, from a multiple perspective. But it's created all sorts of strange things in the market in terms of, and we could talk about this a little bit, sponsors in particular trying to get platform deals done. Like people are just getting priced out of the market. There aren't enough good businesses in market to kind of sustain the number, the platform activity that everyone wants. I'm hoping that 2025 is really the beginning of some shift in that regard in terms of quality, but also, our friends on the private equity side got to start moving assets and start selling things in their portfolio, and those, they will move some good businesses, so anyway, that's a long way of saying, over the past few years, if you had a good business, there was a great outcome. And if your business was struggling a little bit, sure, there was a deal to be done, but maybe not at a super premium multiple. But no, I think owners of, private owners of businesses should, take an honest look at their business. And if it's in good shape, don't be afraid of the market. Like there are willing participants there that are going to pay a fair number for your business.
And Jim, I'm glad you mentioned the platform versus add-on because we've talked about that in the past
Yep.
episodes. And maybe when the market was a little uncertain, valuations down, PEs doing more add-on deals versus platform. Where I know we'll talk a little bit of forecast here at the end of what do we expect in
Yeah.
2025, but what are your thoughts this year on? Is it going to be a more of a shift to PE looking for that platform, that big marquee platform
Yeah.
buy?
Yeah. So they have been looking for those platform buys for years. The problem is they have not been able to get them done because there hasn't been enough platform quality asset in terms of just a good business, but also scale, right? So what that means is, and this is what we talked about last time, there's been a ton of add-on activity, a ton, which is great, especially, for probably this audience, right? A lot of, our mutual clients, so to speak, are wonderful potential add-ons for big sponsor-backed businesses. So that's a great market for those businesses, but it's really hard for private equity to spend 1, 5, 10 billion dollars on add-ons, right? They need the chunky stuff. They need the big deals to get done. And a lot of those platform deals, right? It's sponsors trading between sponsors, right? That's kind of how the market has evolved in some respects. Private equity owns so many businesses, and those businesses are generally scaled and they're pretty well run. And it's time to start moving those assets around. So I expect, not to get too far into 2025, but I am expecting and hoping that we see more of that platform activity, not only from a good, like founder owned business standpoint, but I think sponsors are going to be trading some assets between each other, which will hopefully be an awesome catalyst just for the market in general. But, it should also relieve some of this pressure that is on sponsors right now in terms of returning capital. And just, frankly, they're in the business of transacting, right? And hopefully this year facilitates that a little more readily for everyone.
Yeah, and for those listening, the nomenclature here, if you're not familiar with platform versus add-on, is really when they buy you and you're a platform, they're going to build, I guess, the foundation around you. You're the
Yeah.
main offering, the main product, and then add-on, you're now a kind of a tuck-in, you're a feature, additional product line to a platform. And Jim, I don't know, maybe anecdotally, where do you see, do founders have leverage in one or the other situation here, or is it about equal? If you're, if I've got a SaaS product that's going to be a PE platform buy, do I have more leverage there?
It is situational, Ben, but I'll just maybe generically speaking, if you are going to be the platform, right? that's a big bet for a sponsor. So you've got a little bit more leverage, right? Add-ons, some are absolutely critical. They fit the roadmap. They're a big piece of the future. Others are nice to haves, and when you're a nice to have, not a need to have, you don't quite have the ability to step all the way on the gas pedal, so to speak, around something. And that, that's all relative, of course. But if you are the shiny penny in the big, big platform deal for a sponsor, again, relatively speaking, that doesn't mean you need to be a $1 billion deal or something like that. A big platform deal for someone could be $40 million, depending on the sponsor you're talking to. The reality is, if someone is betting on you as a platform, it's super important for them and they really want to own the business, right? So that gives you, maybe the ability to pull a few levers a little bit further than, some add-on situations, right? Not every add-on situation do you have less leverage, but, generically speaking, platform's going to give you a little more power in your deal.
And I would expect, yeah, a lot of due diligence if you're that platform buy, which we'll
Oh
talk
yeah.
about in a few questions here. But with buyer seller expectations and maybe gaps between those bid ask spread, are we still having to be creative with earnouts, alternative structures to get these deals done?
Yeah. So i- in the situation of a business that is benefiting from some of this scarcity value, Ben, that stuff is really getting squeezed out. Like if you're showing up, if you're a buyer and you're showing up with structure, I won't say you're absolutely going to lose, but it's going to be hard to win, so to speak. For good businesses, we're seeing, meaning, not like the absolute top premium businesses, we're seeing structure find its way into bids, right? So things like earnouts and seller notes and rollover equity and things like that's much more common than it was in 2021. I mean, if you showed up in 2021 with some of that stuff, like you were just kind of dead in the water. And buyers are willing to put that forward now in a bid, because the market is, the pendulum has swung back a little more to the middle, so to speak. Now, that doesn't mean that those buyers who are proposing structure, Ben, are winning those deals, but we are seeing it, right? They're a lot less likely to be sort of summarily dismissed if they have some structure. And frankly, sometimes it's a wonderful mechanism to get a deal done, right? You provide some upside in the future. You have a meeting of minds. A lot of the structure we've been seeing when it does get into a deal, it's not egregious structure, right? It's if there's an earnout, like it's an achievable earnout. And a lot of the commentary from the buyer is, hey, Ben, you told me you were going to do this. All my earnout says if you do what you said you were going to do, I'll pay you. Doesn't that seem fair, right? And of course, from the sell side, there are all sorts of different reasons why we are adverse to earnouts, including you lose control of your own destiny when you're not the owner of the business anymore, and things like that. But the mindset around it has been much more, I think, constructive. Whereas people, including us, historically there have been some kind of punitive or silly proposed earnouts where I'm never going to hit that. Like that's not real value in a deal. What we're seeing along the structure side of things is sort of much more fair or down the middle of the fairway. It's a seller note where they go, hey Ben, I'm going to pay you, 40 today and I'll pay you 10 in a year. And by the way, it's guaranteed. You don't need to do anything. It's just, it's just delayed a year, right? There are structural elements like that are much more common now than even just a few years ago during 2021.
And if I'm a SaaS founder with a premium business, running great financials numbers, what would a clean structure look like, or an ideal structure for that SaaS founder? What should they be going for?
Yeah, I mean, look, it depends on what you want. Meaning, if you want all cash, like that deal's going to be there. If you are, a founder listening to this and you go, look, I want to go sit on the beach. I'm done. Get me out of here. That deal's out there. If you've got a really great business, and they'll pay you cash and you can move on. That's absolutely out there. Now you're going to have, right, a plan. You got to have a good number two that can step into your shoes and run the business, however you want to think about it. Um, but for those that don't want all cash, this idea of rollover equity and playing for the second bite of the apple, I mean, we have had all sorts of founders and owners, not necessarily founders, but owners who have rolled and because they still have gas in the tank, they're excited about the business, right? And this is not the ending transaction. This is a hey, I want to do a deal now, and maybe I'll own 20% or 30% of the business going forward, but I'm going to get a giant check, once I partner with this financial sponsor to help me grow 70% a year, for the next 3 years, and then I hit a big home run. So if you want that, right, to me, Ben, that's not the all cash deal. That's the take enough chips off the table where I go, okay, I'm good. And then really at that point, you're finding the right partner. And if you've got a really good business, you're going to be able to find the right partner. And that's part of our job, is helping, you, Ben, founder, have a bunch of alternatives when you decide to do this. And that is one sort of luxury of running a process is, we get to show you 10 different options, right? And if you've got a really, really good business, Ben, maybe you look at that and you're that founder in those shoes and you go, I like this cash offer, and I love these three financial sponsors, and I think they could make me a boatload of money and I'd be willing to roll with them. Those deals are all out there for people to think about, right? So I don't think there's a perfect, like, this is what you should be looking for. I think it's got to be contextualized with what do you want out of that deal and then picking the right path forward. And if you've got a great business, you're going to be able to do that, right? If there's a forcing function and there's a little bit of pressure around having to do a deal, you might not have as many options, right? Which is probably intuitive to people listening.
And what's a reasonable ask from a buyer if they're, say, the founder owns most of the equity,
Yeah.
and whether the founder is going to stay and operate or just exit completely and not be involved in operations? Is there a reasonable rollover equity ask? That because that helps fund the cash deal. Is it 5%, 10%, 15, or is it just all over the place?
Yeah.
If the founder's like, I don't really want to do it, but okay, I'll do it. Is there a reasonable ask there?
Yeah. So if a founder or ownership group, right, doesn't really want to be involved and isn't going to be involved, usually the percentage of role is smaller, and it might be 5 or 10%, right? And look, that deal, you got to kind of be straight up with the sponsor on what your intentions are and just clearly communicate it. But look, equity for a private equity firm, a sponsor, the equity in the business is the most valuable consideration in their mind that they can give up, right? That's where you get a force multiplier on return. Like they want that, eh? So Ben, if you're telling me, you want to hang around for 3 months and then, move to Jackson Hole and ski and be a whitewater rafting guide, that's great. But I'm not gonna let you do that with 20% of the business that I now own, right? So if you want to stick around and you've got gas in the tank, we usually see sponsors ask for somewhere between 20 and 40% roll. And, almost never then it's gotta be this or there's no deal. Like there are some goalposts, and as long as you're between the goalposts, you're in pretty good shape. And if you want to roll a little bit more, great. If you want to roll a little bit less, that's fine too. So long as, you've got appropriate skin in the game, so to speak, to add value going forward, just because sponsors just view that equity as so incredibly valuable. And they hope that you do too, candidly.
Oh, yeah, definitely. Yeah, makes sense. And talking about funding deals and where this cash is coming from, obviously in the past years ago, near zero interest rates, no, and now obviously interest rates got jacked up. Maybe they're coming down a bit, or who knows, maybe not as much now as we think for 2025. But how have credit markets impacted deals?
Yeah. So, the credit markets have been pretty good in our part of the world, kind of mid-market for 12, 18 months. No, it's not free money, like it used to be, which is fine, but people have learned how to better operate under current debt loads, which is important for us, on the sell side. We need to be interacting with an acquirer universe that is comfortable with how their own business is operating, or it gets very hard for them to buy more, right? Like that's just more stuff to deal with. And we had this period of time where money went from free to not free on a relative basis, right? Everyone took, particular sponsor businesses took on a bunch of debt at really, really, really low rates. And then all of a sudden those rates weren't so low. So they had to figure out, how do I absorb that from an operating perspective? I got to put M&A on hold. Most people have figured that out and are now healthy and running their businesses, which is great. But really debt hasn't been problematic in our part of the market for a while. The private credit has changed the game, right? People aren't just going to banks anymore. There are tons of private credit funds, which adds all sorts of flexibility around that pool of capital. And, it might take a little bit longer to get one closed if someone is running into a snag on the debt side, but it's not egregious, and it's not, for us, it's not putting deals at risk, so to speak. I mean, there was a period of time there where we were really worried about, is this deal going to be able to get done? Because the capital to close, these guys need debt, and it's tight right now. That has loosened up a little bit, which I think has been good, and hopefully that continues into 2025. I mean, who knows where rates are going to go? I mean, but they've come down, which is good, and hopefully we see them come down a little bit more.
Yeah, interesting, because I know in the past we talked, it was maybe causing some delays in deals, and really,
Yeah.
right, with these sponsor buys, these PE buys, yeah, these are levered deals. They need that credit, that capital to close on the deal. So, want to hit some important questions coming up here. So
Yeah.
this may be a hard one, and maybe a little bit of sentiment, but is it a buyer or seller's market right now?
You know, I would characterize certainly 2023 buyer. There were some elements of that in 2024. But I really view it as, frankly, as pretty balanced right now. It's definitely a seller's market if you're the outlier in terms of the really good business and market right now. There is definitely still that scarcity value sort of premium. And I don't mean to suggest that it happens in every deal where you've got a great business, but it is out there as a real thing. Not that that's particularly novel. I think it's just maybe, more pronounced in this particular environment. I mean, of course, great businesses always get premium sort of valuation, but I think in this particular, just part of the market cycle, maybe it's even heightened a little bit more so. And part of that, Ben, is we've talked about it a little bit, but it's, you know, private equity is really the engine for a lot of the software M&A world. So when there's a really good business out there, like that's the opportunity for the platform deal. So everyone kind of descends on it, and is super excited about it, right? So, part of that scarcity value is around, it's private equity. They need to do bigger deals. They need to write bigger checks, and you can't write big checks into B businesses, right? That doesn't fit with the model, right? You write the big check into the A+ business. So when they come out, they get appropriate valuations.
In once we get to that deal and we've got a buyer on the line and due diligence, and I've talked to a lot of founders who've
Yeah.
had failed exits, failed processes because they
Yeah.
weren't prepared for due diligence. And
Yeah.
we'll
Yeah.
talk about metrics and how to prepare. But what is, I know in the past we talked about maybe about 60 days or more for a due diligence timeline.
Yeah.
What are we currently seeing for timelines for due diligence to close the deal?
So 60 days is not uncommon right now. Ben, I mean, look, we got one done this year in 15 days, so you can still get things done really quickly, but it is situational. And I would say that the kind of the average time frame, it's much more, you know, 30, 45, 60, 75 days, not 7 days, 14 days, 30 days. That sure, that's out there. But if I were running a process as a founder, I'd have my head around 60 days and say, it could get done faster. That would be great. It might take a little bit longer. That's okay. But you really, like, if you want any chance of accelerating that, in a process, to your point, you just have to be prepared, right? It's do the diligence for the buyer before you're in market, right? Have all your contracts there, get all your SaaS metrics right, get your financials in order, do all the things that you know are going to come from the buyer, do in advance, and you will save yourself considerable time in a process, especially if you're in a situation where you're post exclusivity, right? Where as a seller, you've lost some leverage, right? If you can accelerate that period of time to close from exclusivity, you're going to do yourself an enormous favor, and we've talked about this ad nauseum, but that's why we spend so much time and effort up front with all of our clients is to make sure that that's never an issue, right? That we are always on on our toes. We're always ahead of where the buyer is going to be. And that allows us to keep the pressure on, keep the leverage up, reduce deal risk and speed close. So
Yeah.
it's just critical. But yeah, at 60 days, that's kind of the seed we plant. So
Okay. Yeah. So it could be short, but yeah, 30 to 60 days, maybe up to 75. And then talk, again, due diligence and, working with decent sized companies where the buyers expect good data, good
yeah.
metrics. What metrics should we be prepared to talk about in
Yeah.
the due diligence process?
Yeah. I mean, for our SaaS clients, we get them focused on all the stuff that you're really great, you know, coaching people through then, particularly around things like retention. So you got to understand logo and gross and net. We talked about this last time, but there was a period of time where net retention, and NRR, that was, if it was above 100%, people overlooked a lot of things, right? They saw that number, it was great, and, coming out of 2021, 2022, 2023, people really shifted to gross and trying to figure out how leaky the bucket really is, right? Because that, it seems intuitive, but like that is the primary indicator around the health of the customer base and the risk to your recurring revenue streams. If upselling or cross-selling stops for whatever reason, either you tap out or the market changes, right? And that leak is big, that's a huge problem. So gross retention, that's where we probably get the most pressure these days is around understanding that metric. And then it's a lot of like blocking and tackling stuff that you would think is, obvious, but there's nuance when you're running a business. You don't always think about these things the way a buyer will. So like the gross profit, gross margin discussion we had, right? Is it fully loaded? Do you have it parsed to revenue streams appropriately? Like we spend a ton of time on that because we know buyers are going to go right there, right? How can I scale this business? What is the gross margin? Because the rest will drop to the bottom line. Like what's EBITDA really?
Mhm.
Is it fully loaded? Do you have a real team, behind this? Or are you wearing 17 different hats, which means you really need to hire 3 more people if you're going to take this thing to the next level? How much does that cost? Are your ad backs legitimate? Right? Stuff like that. And then obviously growth. People are all over growth, And then one thing that's important for folks is, and this is situational, of course, but customer concentration, Ben, is especially as people have you know, I think right size their views on risk and how to think about a business relative to things like customer concentration. We see anytime you start looking at like 20% or more of your revenue in any one customer, you're going to start hitting friction in a process. It's going to run afoul in some way, shape, or form, either a red flag or a yellow flag of a lot of investors, private equity folks in terms of their investment committee just go, look, we can't take that risk on. Associated with that is, if you're growing and you're growing nicely, but there's no new logos or there's very few logos and a bunch of your growth is concentrated in a handful of customers, like stuff like that. Those are metrics that maybe people don't spend as much time on understanding. And so not only is it understanding it, but you need to be able to craft a story around that as to why it's not a risk or as much of a risk in the eyes of the potential owner of the business. So like a strategic might be able to look past it, no problem. But if you're out trying to do a majority recap with the financial sponsor or raise growth equity or something like that. Like that's a risk factor you need to have your head around, because it will impact. For some folks, it's just binary. It's just no, we're not going to do that. We even if we think we can grow out of it, it's just we can't write that check. And others is going to be all around the story of how do you diversify, right? How do we continue to shape this business into something that continues to grow with less risk? So that's another, I guess you could call that a metric. It's kind of another lens into the business that we see pressure on for sure.
In We have a few minutes left. I want to make sure we answer two more questions here,
Yeah.
but just when going to market or thinking about it, are there times where, because sometimes I've seen like, all right, there are forced sales or we've got to go to market for some reason.
Yep.
Are there times where you recommend a founder maybe to reconsider in what metric would, viewing their metrics and if it didn't look good, say retention, would you say, well, probably not the best time. Maybe we have to fix things, or or it's like, hey, just expect right that valuation's just not going to
Yeah.
beat her. But is there like a metric or two where if that looks really bad, you'd say, hey, let's just pause this.
I mean, the one that is really difficult to overcome, man, is like, it's just bad if your retention metrics aren't where they need to be. And that doesn't mean they have to be best in class, right? But if you're below average, that is absolutely going to show up in valuation. And it's, and not in the way you want it to, right? It's going to be going the other direction, which could materially impact, are you going to get to the number that you want to get to, right? I mean, everyone, has some general idea of what is an acceptable valuation in their mind to move forward with the process. It's an enormous undertaking. So we always try and have that conversation up front where if it's, hey, if growth is slowed way down, right? If you've got odd margin degradation, right? Or if your retention is really not where it needs to be, the conversation we generally have is, hey, we would recommend you spend some time to fix this, or let's have a very honest conversation about valuation. And is that still okay for you? Right. But you got to go in eyes wide open or you are wasting your time. So spending some time to fix things can pay huge dividends. Sometimes then we have that conversation and someone goes, you know what, Jim, I got it. I'm not going to be able to fix that in the next 18 months. Like, let's just go get this thing done. I'm fine with that valuation expectation. We've worked with clients who wait 5 years and they fix things and, good for them. It does pay huge dividends and they walk away with the giant check. But yes, the answer to your question is yes. The biggest one is retention. Probably the second biggest one is growth. If growth has really slowed down, single digits, something like that, like that is just hugely impactful to value.
Yeah, definitely. I mean, for me personally, I think, yeah, if you have really bad gross revenue retention, that's going to be a tough one to overcome. But okay, so we have a few minutes left here, and I always love asking this question. So, can founders still achieve a 10x AR valuation, and maybe 10x, is over 10x, maybe it's a 9x, but just something that just seems great.
Yeah.
So, what does it take to get that great valuation right now? Last time we talked about growth, maybe certain revenue thresholds,
Yeah.
profitability. What does it
Yep.
take now?
So the answer is absolutely. I mean, we were doing those deals last year. I expect to do those deals this year. So absolutely founders can still achieve multiples like that. But these probably won't surprise people, but it is stale, right? So there was a period in time, 2021, you could be 5 million in ARR with decent growth and someone might pay you 10 times. And then all of a sudden we had a correction. And, there was a period of time when, if you were at 15 million of ARR, it felt like a real stretch to get to kind of double digit. I would maybe benchmark that at, 10 million of ARR
Mhm.
or within spitting distance of 10 million, meaning you're going to get there in the near term. It's not years away. I think of growth, Ben, as, 40% plus per year. And that's not, look, there are tons of great smaller businesses that are growing 40%, but I'm not talking about if you've got 4 million of ARR growing 40%. Frankly, the expectation is if you're 4 million of ARR, you should be growing at least 40%, right? It's kind of small numbers. So this is 40% growth on 7, 8, 9, 10 million of ARR. You got to have best in class SaaS metrics. You need to be able to articulate your TAM in a way that is clear. And we usually like to see that above a billion. You got to, be profitable or, have a real viable path to profitability. So, and that's not true in every instance. Of course, there are instances where if you're not profitable, you can obtain that multiple, but you're just going to have other things outpace the importance of profitability, meaning your growth is probably exceptional at that point, right? And you're burning to reach that growth. Rule of 40, rule of X, whichever one you want to subscribe to, all of that's important. Growth has definitely come back around in importance, whereas, profitability really took the reins a couple of years back. We've seen that shift, and I'll just, provide a note on it. So we track a ton of public companies, software companies, Ben. I think it's close to 100, and it's remarkable how the landscape has changed as it relates to growth. So like back in early 2022, like 30% of the companies we tracked had LTM revenue growth of more than 30%. So like 30% of the companies had more than 30% growth, and only 25% were under 10%. So at the end of 24, 5% had growth greater than 30%, and more than 50% had growth at 10% or less, right? So it gives you a little insight into why growth has become much more important again, just around, the market has slowed tremendously in terms of growth. So if you are growing, it's a big deal, right? It always has been a big deal, but I think even more so now as maybe it's more pronounced in terms of an outlier relative to your peers, if you can sustain that level of growth at some reasonable scale.
And we got about a minute left for our final question, but to recap, it sounds like, yeah, it can still get, nice valuation,
Yep.
10x, but, threshold around 10 million ARR, growing to that number, 40% growth, best in class metrics, articulate your TAM above 1 billion, and then near profitability or that path to profitability helps to get that. So appreciate that ball, kind of putting the parameters around that.
Yeah.
And so final question, just the time we have left, Jim.
Yeah.
And so trends for 2025,
Yeah.
where are we going this year?
Yeah. So look, we were cautiously optimistic in 23 and 24. I think we're more bullish now, Ben, than we were in both of those years. Look, there's a tremendous amount of pent-up demand. Private equity and strategics, they've got a ton of cash to put to work. We've had a political regime change that, very likely is business friendly. The credit market and rates have largely stabilized. The equity markets are on a tear. And while it's subjective, the feeling we're getting from people when we're talking to them is very positive. And I would say, the consistency of that is stronger right now than it was in 24, where in 24, you had people say, yeah, it feels like it's good, but I'm not exactly sure. Most people now are saying this year is going to be good, period. It might not start in Q1, but it's going to be good. So, what does that all mean? I think deal volume is going to be up this year. I do expect to see it pick up more in the second half than in the first quarter or two. And I think part of that has to do with people feeling out a little bit where this new administration is heading in the first part of the year. There's all sorts of unknowns. It's disruptive. So people are trying to, I think, in some respects, step back and maybe understand that just a little bit. I do hope to see multiples improve some, but my going assumption is things will be relatively flat. I don't think there's going to be some ratchet this year where all of a sudden things that were trading at 5 times, we're trading at 7 times, right? I don't foresee that. I hope that happens, but I wouldn't bank on it. I do think we're going to see private equity begin to sell some of their portfolio assets. I think that's probably more Q2, Q3. And I expect bigger deals to be getting done. And I expect, hopefully, knock on wood, a lot more platform deals getting done, which would be, a great sign, I think, just relative to health of the market, health of private businesses, things of that nature. So that's, I'm hoping all those things happen in some way, shape, or form. But I think I would leave it with, all things considered, we're feeling pretty good. I think it's an interesting time to think about if you've been on the sidelines for a few years, your business is getting better. Now's the time to start thinking about, do you want to go raise some money or do you want to transact? Doesn't mean it has to be this year, but if nothing else, this is maybe a time to begin exploring, preparing yourself for a potential exit, because I think, hopefully 25, the positives of 25 also exist in 26 and 27. So maybe we're on the cusp of, some real, multi-year improvement relative to where we've been.
Well, love it. There we have it. Jim's forecast for 2025. We'll
Right.
check in at the
Yeah, we'll
end of
check
this
in.
year, see how it went, and
Right.
yeah, who knows where it'll go. But I love that forecast. So, Jim, ran out of time today. Love the conversation. And if listeners have any questions, follow ups, what would be the best way to get a hold of you or GLC if they have any questions about what we talked?
Yeah. So just email is fine, Ben, and I can, give that to you, but it's jim.williams@glca.com. Pretty simple. And we provide capital markets updates and stuff like that too. And all of our contact information is in that. All of our contact information is on the website too. So if anyone has any questions, feel free to email or reach out on LinkedIn. We are very generous with our time. We're big believers in giving back, and hopefully we can be helpful in some way, shape, or form as people think about where they are today and where they want to go and do they want to do a deal.
All right. Well, appreciate Jim. Appreciate the all the insight and then the prognosis here for the M&A market and deal market. So, Jim, thanks for your time today.
Thanks, Ben. Appreciate it. Take care.